Hello everyone, welcome back to the channel. So today I'll be delving into S&P Global. So this stock has been hit very hard recently. So I'll be delving into the business model of the company, the risk, and whether or not the company is presenting a decent buying opportunity in today's market. So the first thing that I would like to delve into is the different business segments of S&P Global. As you can see on the screen over here, they have many different business lines under them. So they have market intelligence, ratings, energy, mobility, as well as the S&P 500, which is the indices business. The indices business is a very simple business model, so I won't be touching too much on that one. Market intelligence is that data providing business. So under market intelligence, you have many different business segments. So you have Capital IQ, you have Panjiva, you have Maritime Intelligence, you have Visible Alpha, you have Ratings Direct. All these different products, they come under Capital IQ. So under Capital IQ, I would like to break it up into two main baskets. One of it is the actual platform subscription. The other one is API linked. So for S&P Global, what they're currently doing with their business model is they're trying to reduce the reliance on subscriptions. And what they're doing is they're shifting the clientele towards the API portion. API means, let's say if you go on an Excel and you want to search for S&P Global's data, you can just type it in on Excel and access it from there. So under this market intelligence portion, S&P Global has a few different roles that they try and play. So number one is data scrapper. What they'll do is they'll go online and then they'll try and find all the data, compile it so that it's easier. That one can be done by AI, of course. Second of all is they provide proprietary data. So they have contracts with your private firms. They have maritime data as well under maritime intelligence, one of their business arms. They provide proprietary data that your financial institutions trust. And third of all is that S&P Global actually consolidates and refines the data. So if you look at your SEC annual reports, if you look at your scrap reports online as well, what S&P Global does is they'll try and consolidate them, and then they'll try and refine them as well. So they remove all the unnecessary information that you don't need, and then they'll put it on the platform. The main moat surrounding this market intelligence arm is that the company has proprietary data, which I mentioned earlier as well. Under market intelligence, the company has previously said that around 95% of the data is proprietary, meaning to say your financial institutions, they trust the data. And second of all is that S&P Global, they own the data. So you can't find the data elsewhere, you can't scrap it online. Of course, you have the Microsoft bundling mode as well, similar for S&P Global. What they do is they bundle many different products into market intelligence, and then they sell it under this per seat model to different financial institutions. Under the second business model, it is the ratings business. So for S&P Global, they're basically holding a duopoly with this other company called Moody's. And then there's a third player, which is Fitch as well. So what S&P Global does is they rate the debt globally. So for example, under this business segment, you have 4 different types of debt that are normally rated. So you have your corporate debt, you have your government debt, you have your financial institution ratings, and last of all is your structured finance. Structured finance refers to your mortgage loan securitization, your asset-backed securitization. Your data centers fall under this, which is your structured finance, where they securitize the data center and then they sell it to your investors. So the moat for the ratings arm is this. The company is regulatory backed, that's first of all. It is trusted. And your companies typically get a lower interest rate when they get the ratings from S&P Global as well as Moody's. So what a lot of the companies want to do is they want to try and save on interest expense. So they want to get the lowest interest as possible when they're trying to raise debt. And there is simply no alternative to S&P Global as well as Moody's, because if these companies, they try and get an alternative rater, what will happen as a result of that is your interest rates will go up, which is typically not what the company wants to do. So it's a win-win business model where the company that is trying to get rated, they get a lower interest rate, and S&P Global, of course, they get to rate the debt as well. Of course, the main driver for growth under this ratings arm is the bond market as a whole. So as your bond market goes, what happens is that S&P Global gets to rate more debt. And what S&P Global has under this business arm is 2 different portions. One of it is transactional, the other one is non-transactional. So transactional refers to one-time ratings that the company gets in. So for example, if let's say Meta needs a rating, then S&P Global will provide it. It's a one-time rating. It is under your transactional portion. The other one is the non-transactional portion. This non-transactional portion refers to surveillance ratings. So for example, if your banks need to get rated because it is regulated, then S&P Global will be the one in charge of doing so. Your companies, they typically need to do it every 12 months. So they have to pay S&P Global to get themselves rated. And this forms the non-transactional revenue portion. So besides that, of course, the company's ratings division is affected by interest rate fluctuations as well. because when interest rates go up, the cost of debt is higher and companies will raise less debt. That is typically the trend. And when your interest rates fall, money gets cheaper and more companies will want to try and raise debt. So for S&P Global, they are affected to an extent by interest rates. But I think the better way for you to think about this business model is as such. It's a toll gate to your bond market. So even if a company doesn't get the credit rated this year because the interest rates are a bit higher, because they're a bit more reluctant to raise debt, they will still have to eventually get the debt someday or another. And in the meantime, S&P Global will be able to increase the prices of these ratings, which they have done so over the years. And this company has been steadily creeping up its take rate on the bonds that they rate over the years as well. So I think the best way to put it is, as what Chris Hone has said, recurring revenue is important, but the predictability of the recurring revenue isn't as important, because as long as the money is going to eventually flow to the company, it doesn't matter when, as long as the company has the pricing power to increase prices for the products as well as services, which is what S&P Global has. Next portion is the commodity insights business, which is under this name called S&P Global Energy. So under this energy business, they have mainly two different segments. One of it is they provide benchmarks. They provide benchmarks for pricing of commodities. So for example, if let's say you're searching up for oil, you'll normally see Platts oil. That is the pricing that S&P has provided to all your different exchanges for a specific commodity. And then the second portion is, of course, the data business line, which is also under this commodity insights. They provide data for commodities. And for S&P Global, I think the main mode for this segment is driven more towards their benchmark portion, which is their Platts pricing for different commodities. So why are these spot prices so important? It is because they provide the liquidity in your commodity trading market. So think of it this way, for your different exchanges and for them to attract trading volume, they need to provide a trusted benchmark to match all the spot prices of the different commodities. Say if you don't have this specific benchmark, then what happens is your traders won't trust the platform and then they'll shift over to another platform. So a lot of this Platts benchmark portion is driven by trust, meaning to say your traders, they trust Platts pricing. Your companies, they quote Platts pricing as well because they trust it. And same thing for exchanges, they trust Platts pricing. That's why they put it on the platform. And this is what drives the liquidity for the trading market. So another thing that I found was this, under this Platts business model, they allow big companies, big oil companies to basically put up how much they're trying to bid and how much they're trying to sell their oil for. So it can be seen as sort of like a network effect for all these different companies, and they have incentive to do this as well. So they can see what prices the other companies are willing to buy or let go of their oil for. And this also reinforces Platts' ability to provide accurate prices for the different commodities, which then leads to a more trusted benchmark as well. S&P Global's mobility arm is also being spun away. So they announced in 2025 that they'll be spinning off this business in 2026 this year, late 2026. So after they spin off this business, they'll be fully focused on providing financial data, which I think is a great move for the company. And what the company has done in the past as well is they've spin off a lot more of your non-important business models. Like for example, they spun off McGraw-Hill Education, the education arm in I think 2011. So what they're doing over here is something similar. They're trying to streamline their business model into just financial services data as well as your indices. So as you can see over here, S&P Global has been hit very hard recently. So the stock is down around 21% year to date. It is similar to your software sector as a whole. A lot of your software companies, as we all know, have been selling off. And S&P Global is a victim of that as well. So why is S&P Global selling off? There are mainly a few different narratives surrounding this. So first of all is that AI will be able to provide a better rating as compared to S&P Global as well as Moody's. So my pushback is this: while that is true to an extent, S&P Global's ratings business is entirely built on trust. So what that means is that companies trust S&P Global's ratings. And even if another company comes up with a better ratings that is more predictable, it is impossible for all these companies to switch. It is a language for your ratings portion. It's basically a golden standard. It's a benchmark. And another thing to note is this: all your companies, they pay for the ratings because they're trying to pay for accountability. They're trying to pay for someone to be blamed if something goes wrong. On the other hand, if your AI is the one rating the scores, then there's really no way for all these different companies to try and blame the AI. There's no one to take accountability for that. So my opinion is that this ratings arm is one of the portions of the entire business that is entirely insulated from this entire AI narrative over here. So the second risk associated with the company right now is the market intelligence portion. So the markets are fearful that there will be seed dilution in the future because your agents, they can source the data more easily. But my pushback is this. S&P Global, what they're currently doing with their market intelligence business line is they're trying to shift from a subscription-based business model towards a more API-linked business model, as we mentioned earlier. So what that means is that instead of providing the software, like for example, S&P Global Capital IQ, what they're doing right now is they're trying to do something called Express Feed API. So instead of that, what the company is increasingly doing is they're providing APIs to many different firms. So for example, recently S&P Global, they collaborated with Claude to be a data provider. And based on the numbers, this is a tailwind for the company as well because the company is charging significantly higher for the API portion as compared to the traditional subscription portion. And second of all is that this reduces maintenance costs for S&P Global because under this API portion, they don't really have to maintain the platform itself as compared to your Capital IQ. And besides that, of course, API is less susceptible to churn and it is a lot more sticky as compared to your traditional platform, your Capital IQ platform as a whole. So my opinion as a whole is that the company's entire sell-off right now is currently overblown because number one, the company provides proprietary data. So your AI agents, they can't simply scrap the data online. Second of all is that the ratings narrative is completely overblown because AI cannot get regulated. Only your ratings can be regulated, and S&P Global as well as Moody's, of course, they're regulated. And third of all is that AI could potentially be a tailwind for the company as what the management has suggested as well. Last of all, let's talk about the valuation for the company. So this is my model for S&P Global. So I basically modeled for revenue growth of around 8% over the next few years. For our indices portion, it is tracking the S&P Global average yearly returns as well as your inflows and population increases as well. Second of all is the mobility arm. This is one that is being spun off soon. And your commodity insights arm is forecasted with 7% growth over the next few years. Ratings is forecasted using their bill issuance volumes, which is how much is going to get rated over the next few years. And last of all is market intelligence. This is assuming they have price increases as well as the volume increases over the years as they shift towards this API business model. And what I got as a base case fair value for S&P Global today is around $470 a share. This is assuming a 3.5% terminal growth rate for the company. So I think S&P Global is providing a decent opportunity at today's level. I think the company sell-off is overblown. Of course, this company can sell off a lot lower because markets are fearful today. The markets are pushing back on all the different software companies. Even if companies like S&P Global will not be affected by AI as a whole and might actually be a net beneficiary of this. Anyways, I hope you guys have found this video useful. Feel free to check out our Substack. It's the link in the description box below. I'll be releasing some write-ups soon, some company-specific write-ups, and I'll see you guys soon.